Hello everybody, I hope all of you are doing really well. My name is Siddhant Mehta and welcome you all to Raftaar batch. This is part 2 of chapter number 3, that is valuation approaches, and today we are going to revise everything about income or earning based approach. Today whatever we are going to cover is 90 to 95% similar with your AFM curriculum. So let's understand what do I mean by income or earning based approach. This is a valuation method which helps you decide the value of your asset or company based on present value of all your future earnings or present value of all your future cash flows which you are going to generate from that asset or from that company. Let's understand in which situation we will be using income based approach. Then we will understand when we will be using other approaches with income approach, and then we will understand the three methods which are there in income based approach. Let's first understand in which situation we will be using income based approach. First, you can't value your asset based upon market approach because there is no comparable company for you for analysis. There is no comparable transaction for you for analysis. At that time, you will value your asset based upon income approach. Secondly, management has reasonably projected all the future cash flows which they are going to generate from that asset or from that company. In that case, you can definitely use income approach. Secondly, which are the situation in which you have to use other approaches with income approaches. The first situation is when the asset has not yet started generating income. That means the asset is under development. And in second situation, when your client doesn't not have any access to information relating the asset or a company, that your client is a minority shareholder, he doesn't have any access about company's growth and projection. In this situation, don't only rely on income approach. Calculate the value of your asset with other approaches to have a precise valuation. Then let's understand what are the three methods in income based approach. The first one is PE ratio based method. Second one is discounted cash flow method. And the third one is discounted future earnings method. Let's first understand what is PE ratio based method. This is a relative valuation tool and not a absolute valuation. What do I mean by this? With the help of this method, you will only be able to understand whether your stock price is undervalued or overvalued. This method will help you to compare your performance with your past performance. This method will help you to compare your performance with your peers. But this method will not give you the absolute value of your asset. Hence, this is called a relative valuation tool. Let's understand what is P ratio. This ratio tells us how much investors are willing to pay for each dollar of your company's profit, because we calculate it like price per share of a company upon earning per share of a company. Hence, once we calculate a PE ratio, if there is a higher P, then it indicates that my stock price is overvalued or there is a high growth expectations from investors from my company. And if there is a low PE ratio, it indicates that whether my stock is undervalued or investors are expecting low growth expectations from my company. And as I said, it helps you to compare a company's value with your past performance, and it also helps your company to compare it with other companies in industry. Let's understand the PE ratio method with the help of one example. This is the figures of Simba Cements, and we have to calculate a lagging PE ratio. Here the lagging means based upon past or historical data, and they have also given us lagging industry ratio. They have given us the stock price for three fiscal years, that is 23.78, 16.78 and 12.45. They have also given us the earning per share, that is 2.59, 2.4 and 2.3. Hence, we calculate price upon earnings based upon stock price upon earning per share, and we will get 9.8, 7 and 5.2. Here, the average PE is 7.2 rupees, which is lesser than the industry PE ratio, that is 9.6. It states that my company's stock price is undervalued or investors have low growth expectations from my company. This was your first method of income based approach. Let's jump to the second method. This is the most interesting method and most recognized method, because majority of the valuations in the market are done by discounted cash flow method. As here the name suggests, we calculate the fair value of a business based upon future cash flows. Here we consider those cash flows which are post-tax cash flows, and the same are adjusted with reinvestment needs like your capex and working capital, because this method wants to assess how much cash your company is able to generate after making necessary payments like taxes and reinvestment in the company for future expansion. Then we discount this post-tax cash flow with cost of capital to derive the fair value of the business. How this process gets conducted, we are going to understand in next 15 to 20 minutes. But let's first understand what are merits of DCF method and what are drawbacks of DCF method. So the merits of DCF method is, first, you are calculating worth of your company based upon future projections. So even if there is any short-term market fluctuation, your valuation will not get affected from it. Second, here you are relying on cash flows rather than accounting profit. How this is a merit, I will explain it to you later with the help of an example. Then, what are the drawbacks of DCF method? The first one, your accuracy of a valuation is entirely dependent upon the quality of input which you have taken to determine the projections, because based upon that projections your value has been determined. Hence these inputs are not good, your entire valuation gets distorted. Hence this is a drawback. And second drawback, it does not factor opportunity cost. That means this method is only telling me how much money I will make once I buy this company, but it is not helping me with other investment scenarios where I can earn more than this with the same risk. Hence it is not considering opportunity cost. Secondly, it is also not considering unforeseen cash flow variations. Means you have just made a projection based upon your thinking. You have not considered what if there is economical change, what if there is policy or geopolitical change, how these changes will affect your cash flow. You have not considered it. Hence it is a drawback of DCF method. Let's understand the variance of DCF method. It means which value you can calculate with the help of DCF method. There are two values. One is equity value, which is total worth of company's shares. What I said, total worth of company's shares. And there is enterprise value, which is company's overall worth. These both value we can calculate with the help of free cash flow. Let's understand what do I mean by these two values and what there is a difference between these two values with the help of one example. Here, just for a better understanding, I have prepared a T-shaped balance sheet. This company has an equity balance of 100 rupees, also has a debt of 50 and a cash of 20 rupees. I want to buy this entire company. So what I did here is I pay 100 rupees to the equity shareholders and I became equity owner of this company. Once I became the equity owner of this company, I got control of this cash. This control of cash was not there earlier, but now I have control over this cash. Means I have given you 100 rupees and now I have control of 20 rupees, which make the effective price of buying this company 80 rupees, right? It's not 100 rupees. It's just like I bought one ticket and I get 20 rupees as a cashback, which makes that effective price of being 80 rupees. The same example applies here, and here the effective price of buying this entire company is 80 rupees and not 100 rupees. But as I have control over this cash of 20 rupees, I also have now an obligation on my head of this 50 rupees. Yes, this obligation was not there on me earlier, but now being the owner of a company, I have this obligation of 50 rupees to be repaid. Hence, this will also get added when I am calculating the effective price of buying this company. So I add this 50 rupees and then the price came 130 rupees. My friend, 130 rupees is the effective price of buying that company and not 100 rupees. 130 rupees is the true cost of buying that company, which we also called as enterprise value. And this 100 rupees is just your equity value, which tells us the value of shareholders. It doesn't tell you the value of entire company, but this 130 rupees, which we called as enterprise value, tells us the value of entire company. It considers the cash which will I have control later, and also tells me what obligation I have once I buy this company. Hence, anyone in this world wants to buy this company must check enterprise value and not equity value. we have a common misconception with us that equity value, which is your market capitalization, is the entire worth of a company. No, my friend, this market capitalization, which is your equity value, is just the worth of equity shareholders. And this enterprise value, which we calculate by understanding how much cash we are going to have control once we buy the company, by understanding how much obligation we will be having once we buy this company, is enterprise value, which will tell us the worth of a company. Hence, with the help of DCF method, we calculate two things: equity value and enterprise value. Then you will have one question with you. If enterprise value is telling us the true cost of company, then why we calculate equity value, right? We calculate equity value because for a retail investor like us who wants to buy few shares of the company, for people like us, the more important thing is what will be the worth of company shares, which we can understand by market capitalization. But for the person who wants to buy the entire company, for him, the enterprise value is something which is important. This value will tell him the overall worth of a company, including equity and net debt. Net debt means the debt minus cash. As I said earlier, we calculate both this value with the help of free cash flow. Then you can ask me one question, sir, profit is something which gets to equity shareholders and company. Then why we are calculating these values based upon cash flows? Why we are not calculating based upon profit? This is the right question. The reason we calculate with cash flow because profit is just the accounting concept. Here in profit, there are some expenses like non-cash expenditure like depreciation. Secondly, profit is very easy to manipulate. We are CS. We know how we can change profit just by changing one depreciation method. We will change inventory valuation and then profit will get changed. So profit is very easy to manipulate, whereas cash is not that easy to manipulate. Secondly, cash is what you need to repay debt. Cash is what you need for reinvestment in a company. Also, I will explain you with this one more example. If your company has 100 rupees as a cash profit in your company, but with this 100 rupees, you have taken a debt. Now you have to repay that debt, which is of 50 rupees. So you made the principal repayment of debt of 50 rupees. Now you are left with 50 rupees. Then you taken some 30 rupees out for reinvestment in company. You took that 30 rupees out and reinvest in your company. And now you are left with only 20 rupees. This 20 rupees is free cash flow, which is available entirely to the equity shareholders after making all the necessary payments. Just to understand this in a very layman language, if company gets shut, you will not get 100 rupees as a cash profit. You will only get 20 rupees, which is the payment after making all the necessary payment, which is the cash flow which you have calculated after making all the necessary payments. And that should be, with that value, we should calculate the worth of the equity, because at the end of the day, he will only going to get 20 rupees and not that 100 rupees. Hence, this cash flow is called free cash flow, the cash flow which is freely available to the equity shareholders. Hence, to calculate equity value, we consider free cash flow to the equity and discount it with cost of equity. And calculating enterprise value, we calculate free cash flow to the firm and discount it with WACC. Here, free cash flow to the firm is the cash available with the company before making payment to the equity shareholders and debt holders. That is, before making to any payment to any capital providers, which will help us to calculate enterprise value, because enterprise value is nothing but the value of equity and debt. Let's understand everything this with help with text. So like I said, equity value is the total worth of company and enterprise value reflects the overall worth of company including equity and net debt. We calculate equity value by free cash flow to the equity and discount it with cost of equity, and we calculate enterprise value by free cash flow to the firm and discount it with WACC. Here, the free cash flow of the equity is the cash available for equity shareholders after making necessary payments. And here, the free cash flow to the firm represents the cash which is available for all capital providers. We can derive equity value from enterprise value like this. We will understand it later, but first understand how to calculate free cash flow to the firm and free cash flow to the equity. This is very important, and ICAI will definitely ask you the question on calculation of free cash flow to the firm. I know you have learned this in CA Inter, but let's go through it once. We can calculate free cash flow to the firm and equity by first taking all the revenue. Then we will reduce it with all the necessary expenses which we have incurred other than interest. And we will get EBITDA, that is earning before interest, tax and depreciation. Then we will reduce depreciation of 2000 rupees. Then we will get 11,000. That is your EBIT, earning before interest and tax. Now we will reduce interest, but do we reduce interest in free cash flow to the firm? No, because here we are calculating the cash which is available to all the capital providers, that is your equity and debt. Hence we will not reduce any interest payment which we made to the capital providers. We will not reduce any principal repayment which we made to these debt holders. Hence we will not reduce the interest in free cash flow to the firm. But when we are calculating free cash flow to the equity, which is the cash available entirely to the equity holders, here we will reduce the interest. Then we will calculate tax and we will get profit after tax. Now this is the profit in the company, and now we have to calculate the cash flow. So we will add back the depreciation, which is a non-cash expenditure. We will add it, we will get cash profit after tax. Then we'll reduce the net repayment, that is the principal repayment of your debt. We will reduce it only from free cash flow to the equity and not from free cash flow to the firm. Then we will get cash flow to the firm and equity, and then we will make the necessary necessary cash which we paid for reinvestment in a business, necessary cash which we paid for working capital of a company. We will reduce it, and then we will get a free cash flow to the firm or free cash flow to the equity. This is your calculation. Students make major mistakes in reducing this interest amount or reducing this repayment of debt. Just take care that you are not reducing it while calculating free cash flow to the firm, because we are calculating the cash which is available with entire capital holders. Let's understand what are the adjustments to calculate equity value. What is equity value? The value of entire equity shareholders from enterprise value. And what is enterprise value? Equity value plus debt minus cash. So here we have added debt. Now we have to reduce debt. Then reducing debt is fair value of long-term debt and fair value of short-term debt from enterprise value. Then we will also reduce the contingent liability. This liability was not considered in your books, but it's material and it's likely to be realized. So we will reduce it while calculating equity value. Here we are reducing 3 things and adding 4 things. What we will add here? Here we will add anything which is there in surplus. That is because at the end of the day, if we shut the company, anything which there in the surplus in assets will be directly gone to equity shareholders. Hence, whatever surplus assets we have, we will add it to while calculating equity value. Like cash and cash equivalents, the surplus cash which is there with us, which is beyond our routine business need. Then we will add the surplus assets. These assets are your non-operating assets which are not helpful in your core activities. Then we will take fair value of investments and deposits. These are the investments and deposits which are not part of your core business. That means they are a surplus in your business that will go to the calculating of equity value. Then we add present value of MAT credit. Government tells every company to make 2 types of calculation. One is as per regular income tax and another one is as per MAT. So here government tells that wherever there is higher tax liability, you have to pay that amount. Let me explain you this with an example. In year 1, my regular tax liability was 12.5 rupees, but my tax liability as per MAT was 15 rupees. So government made me pay tax on this 15 rupees. But government also told me that don't worry, you will get this extra amount which you are paying over and above your regular tax liability, that is 2.5 rupees as a MAT credit, which you can utilize in your further years whenever your regular income tax liability is more than MAT. So in year 4, my regular income tax liability is 27.5 and my tax liability as per MAT is 18. So I have to pay tax on 27.5, but government give me this benefit of 2.5 rupees which I have paid earlier, and I made a net payment of 25 rupees. So here you can see whatever extra which I have paid over and above my regular tax liability, that is 2.5 rupees, I have got this amount in a year 4. So if I have paid my tax on regular income tax liability, this amount would have gone to the equity shareholders. This extra 2.5 amount would have gone to the equity shareholders. Hence, we add this while calculating equity value. But we are not getting this amount in year 1. We are getting this amount in year 4. Hence, we calculate present value of it. That's your concept of adding MAT credit in your equity value. With these steps, you will calculate equity value from enterprise value. Just remember that you have to add 4 things and have to reduce 3 things. Whatever you're adding is there in your asset side, and whatever you're reducing is there in your liability side. Then what are the major steps in deriving a value using DCF method? We will understand it. Just give a minute. Sorry. So what are the major steps in deriving the value using DCF method? So these are the steps, and this is your entire calculation of DCF method. Don't worry, in SPOM exams you don't have to calculate this entire value. Maybe in AFM exams you have to calculate it, but I'm showing you so that you must have a proper overview and you should know how you will calculate the value with the help of DCF method. Here you can see we are making projections. So for making a projection, first you have to analyze your historical performance. With the help of historical performance, you will understand, okay, this was the trend in the company, and while understanding the trend, with that help of that trend, you will project the future years. You will prepare the financial projection based upon the assumption that the company is going to continue for next 5 years, and ahead of that also. And with the help of these projections, you will calculate free cash flow to the firm or free cash flow to the equity. How to calculate that? We know it. Then we will calculate discounting factor. If it is free cash flow to the firm, we will take discounting factor of WACC. If it is free cash flow to the equity, we will take discounting factor at cost of equity. Then we will multiply the free cash flows from this discounting equity, and we will get present value of all your future cash flows which you're going to generate. Then we will calculate this terminal value. This is the important thing, because terminal value tells us how much cash flow you're going to generate after the projection years till the infinity, because your company is not going to get shut after in 2028. It will run ahead, but we can't calculate cash flow for each and every year ahead. So we take one value which will represent the cash flow which we are going to generate after the projected year till the infinity. There are 3 methods to calculate it. We will understand it later. Then we will discount this terminal value with this last discounting rate, and we will get the present value of terminal value. When we add the sum of all these cash flows and present value of terminal value, we get the value which we need of that company or an asset. These are the basic steps which are required to calculate DCF method. To calculate your value by using DCF method, like I said, there are 3 important things in doing this calculation. The first one is cash flow projection. The second one is discounting rate, that is your cost of equity and cost of debt, the same thing which you have covered in CA Inter. And then there is a terminal value. These are the 3 methods by which you can calculate your terminal value. These are easy to understand and not very much something which is complicated. Let's first understand what steps you required for cash flow projections. First, you have to prepare a comprehensive financial projections, because you have to prepare the projections for profit and loss statement for 5 years or 6 years, whatever you're projecting. You have to also make projections of balance sheet. With that projection, you will project your cash flows. If these projections are not available to you, at least project your revenue, expenses, capital expenditure and working capital needs. With the help of these, project your cash flow. Then you're projecting your cash flow by understanding your historical financial information. So you must conduct due diligence, and this due diligence should ensure that that there is accuracy in past financial data. You will check whether there is any overvalued asset. You will check whether there is any hidden liabilities. You will check whether there is any one-time cash flow, to understand everything, that each and every financial information which is represented is accurate. For that you have to do due diligence. Then for how much period you must project, it will depend upon some key factors. The first one is business cycle. If your business cycle is of 5 or 7 years, then you have to make the projections of 5 to 7 years, because your entire business cycle must cover by calculating the value of your company. Second, your projections can get based upon asset life. If your asset life is only of 3 years, then you will make projection for 3 years and not for 5 years. Then your projections will also depend upon stable performance period. You want to make projections till the time your company gets stable. You can also do like that. And last thing is reliable and consistent data availability. We will make projections till the time you are reliable that you can estimate. These are the 4 key factors which you have to use while deciding for how much period you have to make projections. Then you have to adjust projection for the known policy changes. That means if there is something which is clear in your management team that after 3 years we are going to do some major expansion, and it's clear on you and you're definitely sure that you're going to make it, then you also have to adjust it while making your projections. Then you have to account for capital expenditure. Then you have to assess working capital requirements, how much money you will be needed for in the years ahead, how much money you will needed for capital expenditure. Then also you have to incorporate tax implication, that how much tax outflow will be there in the upcoming years. If there is any tax holiday benefit or accumulated loss, then till how many years this loss will help us to set off from our future gains, till how many years we are going to get benefits of tax holidays. These are some things which you have to consider while doing cash flow projections. Now let's understand what is discounting rate. See, there are 2 perspectives for looking at discounting rate. One is from investor perspective and another is from company's perspective. From investor perspective, this discounting rate represents the expected return he wants from the company for his investments. But for the company, it represents the cost of raising a funds from in view, that is equity holder or a debt holder. Because at the end, what investor is expecting from the company, is what company has to provide. Hence for investor, this is expected return, and for a company, this is a cost. And you have to calculate WACC for the calculation of enterprise value. WACC is nothing but represents the average cost of capital in your company. So you calculate it with cost of debt into debt upon debt plus equity, and cost of equity into equity upon debt plus equity. This is something which we have learned in Inter, so we will not put more time in it. Here are the capital sources which you can take in WACC are equity shares, preference shares, long-term debt and short-term debt. They have not given you the cost of preference shares. They have only given you here in the syllabus is cost of debt and cost of equity. Then what are the weights which you have to consider while calculating WACC calculation? First, you have to always consider market value weights rather than book value. Second, if this capital structure gets changed each and every year, then you have to calculate WACC calculation for each and every year. Then if question has specifically given you that you have to calculate these weights based upon industry average weights, then you have to consider industry average weights. And in India, mostly we calculate book value weights. Book weights are commonly used than market weights. So what you have to use in exam? Firstly, if any information is given, like if only book information is given or only market value information is given for weights, then consider that. If both the information is given, then always prefer market value weights, because that is something which will give you the precise cost for the company. Then let's understand what is cost of debt. Cost of debt is nothing but the borrowing cost of company which they have incurred to raise that funds. This typically based on the market borrowing rate and varies based upon default risk of the company. So how to calculate cost of debt? For credit rated companies, that means the companies has credit rating given by the companies. Here you will calculate the cost of debt of such companies by risk-free rate and plus this default rate. This default rate will get decided upon what credit rating that company has received. For example, if XYZ had received this credit rating, which means that default spread will be 1.25. Hence, while calculating the cost of debt, we will take a risk-free rate of 7.17 and we will add this default rate by making 8.42, and this will be your cost of debt. And for non-rated companies, means for companies whose credit rating has not been issued, we will take the latest borrowing rate from bank or financial institution. It's easy, but this is important. While calculating WACC, majority of the students make mistakes in this, and there is going to be question on WACC calculation. Majority of the student makes one mistake is they consider cost of debt while calculating WACC. No, my friend, you have to consider after tax cost of debt. Why you consider after tax cost of debt? Because Because of this debt, you made one interest payment. That interest payment was tax deductible, and with the help of that, there was tax savings in your company. Hence, because of your debt, there is a cost to the company, but there is also savings for a company. So while calculating the weighted average cost, you must consider after tax cost of debt. You must also consider that savings. Hence, the formula is pre-tax cost of debt into 1 minus marginal tax rate. Let's understand this with the help of one example. Here is one scenario with the same profit where we have not made an interest payment, and here is the scenario with same profit where we have made the interest payment. So here your profit was 10,000 rupees, then your PBT get 10,000, and you paid tax on this PBT, and your profit after tax is 7,000. Here you have made the interest payment having a debt of 10,000 rupees and interest at the rate of 10%. Here you made interest payment of 1,000 rupees, your PBT is 9,000 rupees. Now your tax will get calculated based on this 9,000 rupees, and you will pay tax of 2,700 rupees. So here you can see you have a tax savings of 300 rupees. So because of that, there is one interest payment, there is a cost to the company, but there has also been a savings in a company which is of 300 rupees. Hence net outflow is 700 rupees, my friend. What I said, the net is 700 rupees. Hence this 700 rupees must be calculated at the time of calculating the cost of debt of a company. So we take KD, that is cost of debt, into 1 minus tax, and we get 7%, which is 700 upon 10,000. This is your after tax cost of debt. Always consider this while calculating WACC. So what is tax impact? For profit making company, there is the tax saving, we just understand it. And for loss making companies, there is no tax benefit, but you can carry forward this loss in the years ahead to set off your future profits. Then what is cost of equity? Cost of equity is nothing but the expected return from the equity shareholders. There are two methods to calculate it. First is dividend capitalization model, and the second is capital asset pricing model, that is your CAPM. So here in this model, that is your dividend capitalization model, it considers that equity shareholders has only two expectations from the company. The first one is of dividend, and the second one is of capital appreciation. So it gives you the formula, like if you invest in your company now, your P0 is the current price of the share, you will get dividend next year, that is D1. That is D1 and P0. Here D1 means dividend which you are going to get next year, and then P0 means price you are going to invest now. So this will calculate the expected return from dividend. Then you will add this with G. Here G represents the capital appreciation which is there in company. Hence you have considered the dividend part, and you are also considered the capital appreciation part. This will help you to calculate the expected return for the shareholder from this dividend capitalization model. So here the P0 is the market price of the equity. The D1 is expected dividend per share for next year. We can calculate it with D0 into 1 plus G, because here we are considering that the capital appreciation in company will be the growth of capital appreciation in company is the same growth in a dividend. Then D0 is the dividend paid in the current year, and D1 is expected dividend in next year. Here K is the cost of equity and G is the expected growth rate. Let's take one example. Here the stock price, the current stock price is 272 per share. Dividend paid in current year is 29.5. Expected dividend growth rate is 10%. So we will calculate expected dividend growth here, that is D1 is 29.5 into 1 plus 0.10, that is 32.45. Then we will take this here you will divide it with 272 and add 10% for capital appreciation, and you will get 21.93. This 21.93 represents the expected return from the equity shareholder. Now let's understand the second method which is used to calculate your cost of equity, that is your capital asset pricing model. Here we calculate the expected return of equity investor based upon the risk which he is taking by investing in specific industry. So here we calculate cost of equity by first considering the risk-free rate, because if that investor has invested his amount anywhere in this country, he would have got minimum risk-free rate return. Then we add it with extra risk which he is taking by investing in equity markets. Is if he is taking extra risk, so he is also expecting extra return. Hence we calculated it by RM minus RF, and then we multiply it with beta, where the beta represents the industry specific risk. Hence this is your entire formula to calculate cost of equity, that is expected return of investor by CAPM model, by understanding the risk which he is taking. So here the risk-free rate will be the percentage of a return which you can get in long-term government bond. If you are a multinational company having your business in different countries, then you have to take long-term government bond of your functional currency and not from where your headquarters is located. Then second, how to calculate risk equity risk premium, that is RM minus RF. We know how to calculate RF. Now let's understand how to calculate RM, that is return from your markets. Here it represents the extra return investor expects for moving from risk-free investment to risky investments, and we commonly determined by historical approach. We consider what is the average return the stock market has given us for 5 years. Here we consider long-term data to avoid any short-term economic fluctuation. Now let's understand how to calculate this beta. You see, beta represents two things. One is how much sensitive it is to the market movements and how much riskier it is. First, understand from stock sensitivity purpose. It represents the sensitivity of the stock from the market movements. That means how much sensitive is your stock based upon market movements. Like if beta is positive, it shows that if market goes upward, your stock will goes upward. If your market goes downward, your stock will also go downward. If your beta is negative, it represents that if your stock goes upward, if your market goes upward, your stock will go downward. If market goes downward, your stock will go upward. This is what we can understand based upon beta. There is one formula to calculate beta, that is covariance of stock return and market return and variance of market return. ICAI will definitely not ask you this calculation in exam because it is very lengthy one and gets asked in AFM but not in SPOM for 1 to 2 marks. Just remember this formula. They can ask this formula in MCQ, that beta is covariance of stock return and market return upon variance of market return. But they can ask question on interpretation of beta values. So if, like I said, if beta is negative, it indicates that your stock move opposite to the market. If beta is 0, it indicates that there is no movement, no correlation with market movements. Like if market even goes upward or downwards, it will not affecting your asset value, that is your cash. Even if market goes upward or downwards, your cash will not change, right? The value of your cash will not change. If beta is less than 1, it indicates that it is less volatile than the market. Like if beta is 0.43, it indicates that if market goes upward by 1%, your stock will go up by 0.43%. If beta is 1, it indicates that your stock moves in sync with the market. If market goes up by 1%, your stock will go up by 1%. And if beta is more than 1, it indicates that your stock is more volatile. If market goes up by 1%, your stock will go up by 2%. But if market goes downward by 1%, your stock will go down by 2%. So a higher beta indicates higher risk because it is more volatile, and a lower beta suggests that there is a stability. How to obtain beta for unlisted companies? Like I said, beta also represents the risk. There are two types of risk which beta represents. The first one is business risk. This is also called as operational risk. And the second one is financial risk, which depends upon company to company based upon their debt levels. So here, to calculate the beta for unlisted companies, what we will do is, first we'll check for comparable companies. Is there any listed company like ours having a similar business model? If there is, then we'll take beta of such comparable company, and then we will unlever the beta. That means there are two types of risk, business risk and finance risk in beta. We will unlever the beta and I will adjust it with debt to equity ratio. That means we will remove this finance risk, because business risk is same for all the business which are working in this industry. Hence we will adjust it with debt to equity ratio and we will remove the element of this finance risk of that company. Here the debt to equity ratio is as per this listed company. We will unlever it, and if we are comparing, and if there are 2 to 3 companies, then we will take the mean of these unlevered betas, and then we will relever the beta for unlisted company. That means we will relever the beta and we will adjust it with debt to equity ratio of our company, and then this business risk and finance risk of our company will give us the beta for unlisted companies. The formula for it is, levered beta formula is unlevered beta into 1 plus 1 minus tax into debt upon equity. Here, the debt upon equity represents how much debt is there in your company. If your debt is more than equity, then it represents that it is much riskier. We multiply it with 1 minus tax to have, because we have a tax savings benefit from that debt, and we add it with 1 because if there is a company which doesn't have any debt, then it will be 0. And if we multiply this 0 with unlevered beta, then your unlevered beta, which is business risk, will become 0, and that's not the case. And that's not the case possible, because each and every company will have minimum business risk, means each and every company will have minimum unlevered beta in there as risk. Hence we add it with 1, so that answer should not be 0. And the same formula is there for beta unlevered, means here the beta unlevered is equal to beta levered upon these things. If you remember this formula, you will be you can easily derive the formula for beta unlevered. Let's understand this with an example. There is one ABC company in IT sector having a debt to equity ratio of 0.75, and there is an unlevered beta of publicly traded company, that is a listed company, of 1.21. So they have directly given us the unlevered beta. Now we just have to calculate the levered beta. The marginal tax rate is 30%, risk free rate is 6%, and the historical risk premium for the market is 3%. Okay. So how to calculate beta levered is equal to beta unlevered, that is 1.21. Then into 1 plus 1 minus tax is 30%, and we will multiply it with debt upon equity. Debt upon equity is 0.75. So here the beta levered is 1.84525, and we will take this beta for the calculation of cost of equity, and we will calculate cost of equity, and our cost of equity will be 11.54. This is your basic calculation for beta, for levered beta. Now let's understand the last thing. Which is there in your DCF calculation, that is terminal value. Like I said earlier, terminal value represents the cash flow beyond your projection period till infinity. There are 3 methods to calculate terminal value. The first one is salvage value, second one is exit multiple, and the third one is Gordon's growth model. Here we will use salvage value when the company is ceasing their operations and liquidating their assets. So here you calculate terminal value based upon realizable value of asset at the time of selling the asset when you are closing your company minus disposable cost. So here the terminal value is realizable value of asset minus disposable cost. We will use it at the time of ceasing the operations and liquidating the assets. It's a simple method. Then the second method is exit multiple. Here you calculate terminal value based upon your comparable company. First you will check your comparable company, and you will see what terminal value they are charging. Then with that you will determine multiple, and from that multiple you will derive your terminal value. It's same like market approach. Hence this method is called as hybrid valuation technique, because here you are using as market approach, because this method is same like market approach, and we are using it in DCF, which is an income approach. Hence this is called as hybrid valuation technique. Let's take an example of it. Amino Limited is a company having a sales of 10 crores and has a terminal value of 25 crores at the end of 7 years. Then we will calculate the terminal value, then we will determine sales multiple from it. It is 2.5x, which is 25 crores divided by 10 crores. And then we will use this multiple for calculating our terminal value. We will multiply 2.5x into 20 crores, that is our company sales, and we will get the terminal value of 50 crores. This is your second method, which is exit multiple. And the last method is Gordon's growth model. This is method which is mostly used in valuation while calculating terminal value. The formula here is expected future cash flows into 1 plus G divided by KE minus G. We will not go into derivation of this formula because it will take time, and I also have to explain you about geometric progression. Let's understand this formula. Derivation is something which you can learn in AFM. So the formula here is expected future cash flow. This cash flow is the last projected year's cash flow. You will multiply it with 1 plus G, and then you will divide it with cost of equity minus G. Here are some basic key points given about this formula. Just go through it once. We'll go to the example. So they have given us the data of PQR Limited, which is a private limited company, and told us to calculate the present value of terminal value. Here they have given us the data of cash flows, and given us that the cost of equity is 10.95 and the growth rate is 3%. So for terminal value, we take expected future cash flow, that is a projected cash flow of last year. We will multiply it with 1 plus growth rate, so 3101 into 1.03, and then we will divide it with cost of equity minus G, that is 10.95% minus 3%, and you will get your terminal value. So this is how the terminal value gets calculated by Gordon's growth model. This is everything about discounted cash flow. Now there is the last method, that is discounted future earnings method. ICAI has not explained much about this method. They have only given 2 to 3 lines for this method, and I've told you that this is the one method which is there in income based approach. So here you calculate the present value of your business based upon future earnings. The same way you calculate in DCF by cash flow, here you will be using future earnings. The other steps are, there you are calculating cash flow projections. Here you will do earnings projection, then you will have a discount rate selection, then you will do the discounting, and then you will do the summation of, that is sum of present value of all your future earnings. This is the same way by this is the same thing in DCF. You take cash flow, here you take future earnings. Sir, but you said the cash flow is something which gives us more precise picture, then why we are using future earnings method here? The reason is there are some companies who have positive in earning but are negative in cash flow. For those companies we will use discounted future earnings method, for those companies who have negative cash flow. Then this is just from my end to calculate enterprise value and equity value. Just go through it once. This was your entire lecture, revision lecture about income or earning based approach. I know this lecture is lengthier, but this is also for those students who are learning these concepts for the first time. So, and don't worry, ICAI will not ask you question about entire DCF calculation, or they will not give you 2 to 3 adjustments. They will ask you simple questions like calculate the terminal value using Gordon's growth model. They will ask you calculate the leverage beta. They will ask you to calculate WACC calculation. They will ask you to calculate free cash flow to the firm. These some things are the questions which they will ask you. Hence, understand this simple formula and you will be covered for this chapter. If you're loving this lecture, let me know in the comment section below, and don't forget to subscribe because your one click is enough motivation for me to keep going. Okay, tata, bye bye, see you in the next lecture.